So I think the biggest macro story is the widening divergence between fiscal policy and monetary policy. That's been a theme I've been focusing on for a while now, and it continues to be kind of the major backdrop that not a lot of market participants, I think, fully grasp because it's been a very, very long time since a market has been in this type of situation. And so what I mean by that is we take out fiscal policy, that's, what the government's doing. So they're spending into the economy, they're taxing from the economy, they're running deficits. And so how large those deficits are as a percentage of the economy basically refers to fiscal policy. And so they're running unusually large deficits as a percentage of GDP, especially outside of a recession. On the other hand, you have monetary policy, which is things like interest rates and balance sheet by the Federal Reserve, or if it's another country, their central bank. And they're in the United States and most other countries, they're being very tight right now. So they're holding rates fairly high at relatively high periods over the past 20 years or so. They're trying to reduce their balance sheet, and the purpose of that is to try to slow down bank lending.
In a recent analysis, Lynn Alden delves into the intricate dynamics of fiscal and monetary policies, shedding light on the widening gap between the two. With fiscal deficits soaring, while central banks maintain a tight stance on interest rates, a peculiar scenario unfolds in the financial landscape. Alden highlights the repercussions of this divergence, particularly evident in the reluctance of banks to lend amidst heightened uncertainties. This caution is exacerbated by sectors like commercial real estate facing immense pressure from tightening monetary policies. Yet Alden underscores the nuanced impacts, noting that larger banks exhibit greater resilience compared to regional counterparts. This insightful analysis underscores the complex interplay between policy decisions and their ripple effects throughout the economy. Stay informed on the latest financial insights by liking, sharing, and subscribing to our channel. And don't forget to turn on post notifications for timely updates.
And therefore slow down the economy, slow down the demand side of inflation to allow prices to kind of stabilize for a period of time. But the problem is that, when they did that back in, say, the 1970s, right? So back in the 70s, you had very low public debt to GDP. And so when you raise interest rates, you slow down bank lending, which is where most of the inflation was coming from in that period. And you do increase government debt interest rates, which can increase the deficits. But when the debt's so low, that's a much smaller factor than the bank lending. And so it has a net slowing effect. When you fast forward to today with 130% debt to GDP or so, when you raise interest rates dramatically, you result in absolutely massive government interest expense increases, which is it adds to the deficit. And a larger fiscal deficit tends to be nominally stimulative. It depends on what they're spending it on, how really stimulative it might be. But at least while it's happening, that can be quite stimulative. It can be inflationary, it can be pro GDP, nominal GDP growth, and that's being offset by that tightening. But when you get into this period of very high public debts like we're in now, it can be called fiscal dominance, which is that monetary policy begins losing its effect. They run out of ways to slow down the economy because by increasing interest rates, although they do decrease the rate of bank lending, they blow out the government interest expense so much that it's actually the stimulatory forces can equal or exceed the tightening forces that they're doing, and you get kind of in a feedback loop. And that's at the moment that's what the economy's experiencing, and the result is the bigger divergence between different types of sectors. So, for example, commercial real estate is in shambles. It's doing very poorly. It's very interest rate sensitive. It's very vulnerable to those higher interest rates. But on the other hand, sectors that are not very interest rate sensitive are in general doing pretty great. And so you get that really big gap that's wider than normal market conditions. Yeah, pretty much. You have fiscal monetary policy going the other direction. It's kind of like slamming on the gas pedal while like holding the emergency brake, right? It's just, you get a very weird effect. Then it becomes which one's bigger. And overall, fiscal is bigger, and that's what we're going through right now. At least for the market in aggregate, there are some sectors that are more affected by monetary policy, but overall, fiscal policy is winning. And then, ironically, that and the key part is that tight monetary policy feeds into more fiscal by increasing the government interest expense, which increases the overall deficits. And there are people and companies on the other side of those deficits, on the receiving side. So, for example, if I have a fixed rate mortgage on my house and I have a bunch of cash equivalents in money markets and T-bills and things like that, then the higher the Federal Reserve raises interest rates, my liabilities don't change, like my monthly interest expense doesn't change, but the income I get from my cash equivalents goes up, and so that I can actually spend more into the economy. And you can imagine there's a lot of upper class, upper middle class, especially older investors, baby boomers, older generations that have quite a bit of cash equivalents and, either no debt or fixed rate debt. And so they're in a very different situation than you'd expect from normal tightening policies. You also see this in corporations. So, for example, there are many large profitable companies that have very long-term corporate bonds at low interest rate. That's their liability, and then they have plenty of cash equivalents that their interest rates go up when interest rates go up, and so they're receiving a lot of interest income, and they're able to spend that on acquisitions or dividends or buybacks and things like that, and reward shareholders. And so all of that does trickle into the economy, just maybe not as rapidly as something like stimulus checks, just because of where that income's going, but it is a stimulatory force. Banks have divergence. If you're a very large bank, most large banks don't have a ton of commercial real estate exposure. They're facing some pressure from the fact that, in general, they have mortgage loans and things like that on their asset side. So they can be somewhat squeezed, but then it really comes down to the individual bank, right? So larger banks tend to be in more secure condition than like kind of regional banks. And then it comes down to individual banks manage duration better than other ones. So banks that are heavily in commercial real estate, a lot of them are in trouble. Whereas, for example, American Express, they're a bank entity, and they've been doing great, because they don't really have that duration mismatch problem. So yeah, it really depends on the type of financial institution. Yeah, the main factor was the shortening of treasury durations. And that was one of the possibilities I outlined in a number of my writings around that time. I basically said, here's a problem that's forming, and here's a few different outcomes. And until you know what outcome's going to happen, it's challenging to predict it because these are human decisions. So, for example, what is Janet Yellen going to do? What is Jerome Powell going to do? And so, what they ended up choosing was the Treasury shortened their average duration of bonds, right? So instead of issuing long duration bonds, they issued short duration T-bills. And what makes that relevant is that there was a $2 trillion build-up reverse repo facility, that money market funds primarily were investing in. And that basically represents available capital, but only for short duration government debt. It can't really be used to buy that longer duration stuff. And so by shortening their average duration, they're able to pull money out of the reverse repo facility and spend it back into the economy. And now they're down to about a quarter of that. So now they're down to about 500 and some billion. So they can't do that forever. But that's been a very long runway of additional liquidity they've been able to push back into the system. And again, this was outlinable in advance, but as a fairly rare occurrence for the Treasury to shorten their duration this much. And it costs them to do it because that's actually the more expensive part of the curve. So my outline at the time was we have to see what's going to happen here. And it's kind of like how, if you're playing a certain game and like you get a little bit more information from the game, like if you're trying to figure out if an item, like with those game shows where there's three doors and there's like an item behind one door and you're trying to get that one. Once they open one door, that gives you more information to make your next decision with. So basically, it was like, okay, be careful. But then once it was clear that the Treasury was shortening T-bills, that's a very kind of overall bullish thing for basically overall stimulatory force. Again, unless you're in one of those sectors that's specifically very sensitive to the monetary policy, like commercial real estate.
In today's discussion, we've delved into the fascinating dynamics between fiscal and monetary policies as expertly dissected by Lyn Alden. We've seen how the widening gap between these policies is reshaping various sectors of the economy, with implications for both investors and consumers alike. From the cautious approach of banks amidst tightening monetary policies to the nuanced impacts on different financial institutions, the insights shared today offer a deeper understanding of the current economic landscape. We hope you found today's analysis informative and thought-provoking. If you did, don't forget to subscribe to our channel for more insightful content. Remember to like this video and share your thoughts in the comments section below. Your feedback is invaluable to us as we continue to explore and dissect the complexities of the financial world. Thank you for watching, and until next time, stay informed and stay tuned.